Before we dive in, please remember that this presentation is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided is not intended as financial, legal, or insurance advice. You should always consult with a qualified professional before making any decisions about your insurance coverage. The rates, coverages, and discounts discussed are subject to change and may not be available in all states or to all individuals. Picture this for a second. You're driving on a perfectly normal Tuesday afternoon, maybe heading home from work, maybe running an errand. The sun is out, your favorite song is on the radio, and then, out of absolutely nowhere, bam, that gut-wrenching sound of metal on metal. Your heart plummets into your stomach. And after the initial shock wears off, one single terrifying question floods your mind. Am I covered for this? You remember signing up for car insurance. You remember getting a little card to put in your glove box. But the actual details? What your policy truly covers? It's a complete blur. Is your deductible $500 or $1,000? Do you have rental car coverage? What happens if the other driver doesn't have insurance at all? That moment of sheer, paralyzing uncertainty is exactly what we are going to eliminate today. This video is your definitive guide to navigating the often confusing, jargon-filled world of auto insurance, and we're putting one of the biggest names in the industry under a microscope: Farmers. We're going to cut through the marketing, decode the policy documents, and give you the straight-up, unfiltered information you need to decide if Farmers is the right choice to protect you, your car, and your financial future. By the time you're done watching this, you won't just understand your insurance options. You'll feel confident, empowered, and in complete control. So why Farmers? Why focus on them? Because they are a household name. You've seen the commercials with the brilliant J.K. Simmons. You've heard the iconic jingle 1,000 times. We are Farmers, bum-pa-dum, bum-bum-bum-bum. They're one of the largest and oldest insurers in the United States, founded way back in 1928, originally to offer quality insurance to, you guessed it, farmers and ranchers. But over nearly a century, they've grown into a titan of the industry, insuring millions of drivers from every walk of life. Their brand is built on a promise of experience, knowledge, and reliability. But does the reality live up to the reputation? That's the billion-dollar question. To answer that, we have to start with the absolute fundamentals. What are you actually buying when you buy a car insurance policy? It's not just one thing. It's a bundle of different coverages, each designed to protect you from a different type of financial disaster. Let's break down the core components you'll find in virtually any auto policy, including one from Farmers. First up, and most importantly, is liability coverage. This is the one part of your insurance that is legally required in almost every single state. Think of liability as the "I'm sorry I messed up" coverage. It doesn't protect your car or your injuries. It protects your bank account if you cause an accident that injures someone else or damages their property. It's broken into two parts: bodily injury liability and property damage liability. Bodily injury, or BI, covers the medical bills, lost wages, and pain and suffering of the people you might injure in an at-fault accident. When you see numbers like 25/50th, that means your policy will pay up to $25,000 for one person's injuries and a maximum of $50,000 total for all injuries in a single accident. Property damage, or PD, is simpler. It pays to repair or replace whatever you hit, whether it's another car, a mailbox, a storefront, you name it. A number like 25 means it covers up to $25,000 in property damage. Now, here's the critical part. State minimums are often dangerously low. A new car can easily cost more than $25,000, and a serious medical injury can skyrocket into the hundreds of thousands. Skimping on liability is one of the biggest financial risks you can take. Next, we have the coverages that protect your car. These are collision and comprehensive. They are almost always sold together, and are usually required if you have a loan or lease on your vehicle. Collision is straightforward. It pays to repair or replace your car if it's damaged in a collision with another object, whether that's another car or a telephone pole. It doesn't matter who was at fault. If you hit something, collision coverage is your best friend. Comprehensive, on the other hand, is sometimes called other than collision coverage. This is for all the bizarre, non-driving related chaos that can happen to your car. A tree branch falls on it during a storm? That's comprehensive. To get stolen? Comprehensive. Hail damage, fire, vandalism, hitting a deer? All comprehensive. For both of these coverages, you'll choose a deductible. That's the amount of money you have to pay out of pocket before the insurance company starts paying. A higher deductible means a lower monthly premium, but it also means more financial pain if you have to file a claim. Now, what happens if the person who hits you doesn't have insurance or doesn't have enough insurance to cover your bills? This is a terrifyingly common scenario. That's where uninsured and underinsured motorist coverage comes in. This is a crucial piece of the puzzle. Uninsured motorist or steps in to pay for your medical bills and, in some states, your car repairs if you're hit by a driver with no insurance at all. Underinsured motorist or kicks in when the at-fault driver has insurance, but their liability limits are too low to cover the full extent of your injuries. This coverage essentially protects you from the irresponsibility of other drivers on the road. Finally, depending on your state, you'll likely see either medical payments coverage, often called MedPay, or personal injury protection, known as PIP. Both are designed to cover your medical expenses and those of your passengers after an accident, regardless of who was at fault. This is your first line of defense for immediate medical care. PIP, which is mandatory in no-fault states, is generally more comprehensive and can also cover things like lost wages and rehabilitation services if you're unable to work after an accident. Okay, that's the universal foundation. Liability, collision, comprehensive, uninsured motorist, and MedPay/PIP. Every major insurer offers these. So what makes Farmers different? How do they package and sell these core coverages? This is where Farmers starts to distinguish itself. They don't just throw a bunch of options at you and hope for the best. They typically structure their offerings into tiered packages, often called Standard, Enhanced, and Premier. This is designed to simplify the buying process. The Standard package is your basic, no-frills option. It's built to be affordable and meet the legal requirements, giving you solid, fundamental protection. It's for the budget-conscious driver who needs reliable, essential coverage. The Enhanced package is the middle ground and often the most popular choice. It takes the standard coverages and bumps up the limits. It also starts to introduce some of Farmers' signature features, which we'll dive into later, things like accident forgiveness or a diminishing deductible. This is for the driver who wants a little more peace of mind and a safety net beyond the bare minimum. Then you have the Premier package. This is the top tier, all the bells and whistles option. It's designed for maximum protection and convenience. You'll find the highest liability limits here, along with a suite of valuable endorsements bundled in, like new car replacement and loss of use coverage that gives you a higher daily limit for a rental car. This is for the person who wants to know that no matter what happens, they are covered to the fullest extent possible. This tiered approach is a key part of the Farmers' experience. It's an attempt to guide you toward a logical choice based on your needs and budget, rather than forcing you to build a policy from scratch, which can be overwhelming for most people. But the real value, the secret sauce, is often found not just in these packages, but in the specific, unique endorsements and features they offer. Things that can turn a good policy into a great one. We're talking about specific perks that can save you thousands of dollars in a worst-case scenario. But coverage is only one half of the story. The other, equally important half is the price. How does Farmers actually determine what you'll pay? What are the hidden factors that can cause your rates to spike or drop? And most importantly, what are the specific discounts, the ones you might not even know exist, that you can use to slash your premium? That's exactly where we're going next. Let's start with the price tag. The number that shows up on your quote can feel like it's pulled out of thin air, but it's not. It's the result of a complex calculation, a risk assessment so detailed it knows more about your driving future than you do. Think of it like a puzzle. Farmers, like every insurer, is trying to piece together a picture of you as a driver, and every piece of that puzzle affects your final premium. Now, some of these puzzle pieces are obvious. You already know them. Let's call them the unavoidable trio. First, your driving record. This is the big one. Tickets, accidents, DUIs. These are the red flags that scream high risk. A clean record for the past 3 to 5 years is your golden ticket to lower rates. Second, your location. Where you park your car at night matters a lot. A driver in rural Wyoming is going to pay a fraction of what a driver in downtown Los Angeles pays, simply because the odds of theft, vandalism, or a collision are astronomically higher in a dense urban area. They look at your specific zip code, analyzing local accident rates and crime statistics. And third, the type of car you drive. A brand new high-horsepower sports car costs a fortune to repair or replace, so it costs a fortune to insure. A 10-year-old reliable sedan? Much, much cheaper. They look at safety ratings, theft rates for your specific model, and the average cost of repairs. But that's where most people's understanding stops. And it's the factors you don't see that can have a shocking impact on your rate. Let's talk about the hidden pieces of the puzzle. One of the most controversial, yet powerful factors is your credit-based insurance score. Now, this is not the same as your FICO score, but it's related. Insurers have found a strong statistical correlation between how people manage their finances and how they manage their driving. The data suggests that individuals with higher credit scores tend to file fewer claims. It's not about how much money you have, it's about perceived responsibility. A lower score can significantly increase your premium in most states, while a great score can give you a substantial, built-in discount. Another one, your occupation and even your level of education. It might seem unfair, but again, it's all about statistics. Actuaries have found that people in certain professions, like teachers, scientists, and engineers, tend to have lower accident rates. So, if you're in one of these preferred professions, you could see a lower rate right off the bat. And here's one that surprises a lot of people: your marital status. Married individuals consistently pay less for car insurance than single individuals. Why? The data shows that married drivers, on average, are involved in fewer accidents. They are statistically seen as more stable and less risky. So you have the things you can't easily change, like your age and where you live, and the things you can, like your driving record and your credit. But understanding these factors is only half the battle. Knowing the why behind your rate is your foundation. Now let's build on it. Let's talk about how to actively, strategically, and systematically dismantle that premium. This is the Farmer's Discount Playbook. This isn't just about asking, are there any discounts? It's about knowing which discounts exist and making sure you get every single one you qualify for. We can break them down into three main categories: driver discounts, policy discounts, and vehicle discounts. Let's start with you, the driver. The most powerful tool Farmers offers here is their telematics program, which is called Signal. This is a smartphone app that monitors your driving habits. And I know what you're thinking. I don't want my insurance company watching my every move. But let's be pragmatic. The app tracks things like hard braking, excessive speed, late-night driving, and distracted driving. Like using your phone while the car is moving. The better your driving score in the app, the bigger your discount. Good drivers can see discounts of up to 15% initially, and that can climb as high as 30% at renewal. If you are a genuinely safe, defensive driver, this is, without a doubt, one of the biggest single discounts you can get. You are literally turning your good habits into cash. Next up in the driver category is the good student discount. If you have a driver on your policy who is in high school or a full-time college student under the age of 25, and they maintain a B average or better, you need to be getting this discount. Can be significant, often saving you 10 to 15%. You just need to send in a copy of their report card or transcript each term. There's also a distant student discount for college students who attend school over 100 miles from home and don't take a car with them. Then there are the mature driver or defensive driving discounts. If you're over a certain age, usually 55 or 65, and you complete an approved defensive driving course, Farmers will give you a discount on your policy for 3 years. It's a small investment of time for a guaranteed return. Now let's move to the second category: policy discounts. This is where you can get creative and find massive savings through bundling. The multi-policy discount is the king of all discounts. If you have your auto insurance with Farmers, and you also bundle your home, renters, or life insurance with them, you will see a huge drop in your premium. Insurers love customers who put all their business in one place. It increases customer loyalty and retention, so they reward you heavily for it. We're not talking about a 5% discount. We're talking about a serious reduction that can often make bundling cheaper than having separate policies with the cheapest individual companies. Another big one here is the affinity discount. This is one of the most underutilized discounts in the entire industry. Farmers has partnerships with hundreds of employers, professional groups, and organizations. Are you a teacher, a firefighter, a police officer, a nurse, or a member of the military? There's likely a discount for you. Are you a member of a certain credit union or a university alumni association? There could be a discount for you. You have to ask. Go to the Farmers website or call an agent and list the groups you belong to. It's found money. There's also the simple pay in full discount. If you can afford to pay your entire 6-month or 1-year premium upfront, you'll avoid monthly installment fees and often get a small percentage off the top. The electronic funds transfer or EFT discount is similar. Set up automatic payments from your checking account, and they'll knock a little bit more off. It's about making things easier and more predictable for them, and they pass a little of that savings on to you. Finally, we have the third category, vehicle discounts. These are all about the car itself. The most basic are the safety feature discounts. Does your car have anti-lock brakes, airbags, and automatic seatbelts? Most modern cars do, and that gets you a small discount. But there are bigger ones. An anti-theft device, especially a passive one that automatically engages like an engine immobilizer, will get you a discount. A more advanced system like LoJack could get you an even bigger one. And here's a newer one to look for: the alternative fuel discount. If you own a hybrid or an electric vehicle, Farmers offers a discount of around 5% in many states. It's their way of rewarding you for driving a greener car. So let's put it all together. Imagine a 45-year-old married teacher with a good credit score and a clean driving record. She drives a 2018 Toyota Camry with modern safety features. She bundles her home and auto insurance. She enrolls in the Signal app and proves she's a safe driver. She's part of a teachers' union that has an affinity discount with farmers. And she pays her bill in full via EFT. She is stacking discount upon discount upon discount. Her premium will be a world away from someone with the exact same car and driving record who just signs up for a basic policy without asking any questions. She isn't just a customer. She's a smart consumer who understands the system. This is the key. Your auto insurance premium is not a fixed price. It is a negotiation based on data. By understanding the factors that build your rate and the discounts that break it down, you take back control. You're no longer just accepting a number. You're helping to create it. But all the discounts in the world won't matter if you have the wrong type of coverage when you actually need it. Getting a cheap policy is easy. Getting the right policy at a great price is the real goal. What is the bare minimum coverage the law requires, and why is it almost never enough? What's the real difference between liability, collision, and comprehensive? And what is the one, often overlooked optional coverage that could literally save you from financial ruin after a serious accident with an uninsured driver? We're breaking down the policy itself line by line so you understand exactly what you're paying for. That's coming up next. Alright, let's pull up a chair to the engine of your insurance policy. The declaration page. This is that piece of paper or that screen in the app with all the numbers and jargon that makes most people's eyes glaze over. But this right here is where you find out if you're properly protected or dangerously exposed. We're going to translate it from insurance essay into plain English. First up, the absolute bedrock of any auto policy: liability coverage. This isn't for you. It's for the other guy. If you cause an accident, this is the part of your policy that pays for their medical bills and their property damage. It's the law, and it's non-negotiable. Now on your farmer's policy, you'll see it broken down into two parts: bodily injury liability and property damage liability. And next to them, you'll see a series of numbers like 25/50/25 or 100/300/100. What on earth do those mean? Simpler than it looks. Let's use 100/300/100 as an example. The first number, 100, stands for $100,000. That's the maximum amount your policy will pay for any single person's injuries in an accident you cause. The second number, 300, is $300,000. That's the maximum total your policy will pay for all injuries combined in that same accident. So if you hit a car with 3 people in it, your insurance will pay up to $100,000 for each of them, but no more than $300,000 for the entire group. The final number, the second 100, is for property damage. That's $100,000 to repair or replace whatever you hit, whether it's another car, a fence, or a storefront. Now here is the single most important piece of advice you will get in this entire video. State minimum liability limits are a trap. I repeat, a financial trap. Many states only require something absurdly low, like 25/50/25. Let's play that out. You're driving home, you glance down at your phone for a split second, and you rear-end a brand new Tesla Model S. A simple repair on that car, with all its sensors and specialized parts, can easily top $30,000 or $40,000. Your $25,000 property damage limit is already exhausted. That extra 15 grand? That's coming out of your pocket. But what if the driver and passenger have to go to the hospital? A single ambulance ride and an ER visit can be $10,000. What if one needs surgery? Suddenly, that $50,000 total bodily injury limit looks tiny. If their medical bills hit $80,000, and you only have $50,000 in coverage, guess who they're coming after for the other $30,000? You. They can go after your savings, your investments. They can put a lien on your home. All because you saved a few bucks a month by sticking with the state minimum. The difference in premium to go from state minimum to a much safer level like 100/300/100 is often less than the cost of a couple of pizzas a month. It is the cheapest peace of mind you can possibly buy. Okay, so that's liability, it covers the other person. But what about your own car? That's where the next two famous coverages come in: collision and comprehensive. People mix these up all the time. Here's the easy way to remember it. Collision covers damage to your car from, well, a collision. Hitting another car, a pole, a guardrail, a fire hydrant. If you are in motion and you hit something, that's a job for your collision coverage. So if you slide on some black ice and smash into the median, you'll be making a collision claim to fix your car. Comprehensive, on the other hand, covers almost everything else. Think of it as acts of God or weird stuff coverage. A hailstorm makes your car look like a golf ball? That's comprehensive. A deer decides to play chicken with your front bumper at 60 miles an hour? Comprehensive. A tree branch falls on your hood during a windstorm? Comprehensive. Your car gets stolen, vandalized, or catches on fire. All comprehensive. It's for damage that happens when you're not colliding with something. Now, with both collision and comprehensive, you'll have a deductible. This is the amount of money you have to pay out of pocket before Farmers starts paying. A common deductible is $500 or $1,000. So if that hailstorm causes $3,000 in damage and you have a $500 deductible, you pay the first $500, and Farmers pays the remaining $2,500. The higher your deductible, the lower your monthly premium will be. It's a trade-off. If you're a safe driver with a good emergency fund, a higher deductible might save you money. If you'd rather have a smaller, more predictable expense after an accident, a lower deductible is the way to go. But remember, if your car is older and not worth much, paying for collision and comprehensive might not make sense. If your car is only worth $1,500 and you have a $1,000 deductible, you're paying a premium all year for a maximum payout of only $500. Do the math and see if it's worth it for your situation. Now we get to the one we promised. The single most underrated, overlooked, and catastrophically important coverage you can have: uninsured and underinsured motorist coverage. Let's go back to our accident scenario. But this time you do everything right. You're sitting patiently at a red light. The light turns green, you proceed, and bam! Someone blows through their red light and T-bones you. Your car is wrecked. You're seriously injured. It was 100% their fault. The police show up, they write the report, and they hand you the other driver's information. And that's when you get the sickening news. They have no insurance. Or they have that worthless state minimum policy we just talked about, which won't even cover the ambulance ride. What happens now? Without uninsured motorist coverage, you are in a world of hurt. The other driver is personally responsible, sure, but if they can't afford insurance, do you think they have $50,000 sitting around for your medical bills and lost wages? Of course not. You can sue them, but it's called suing for nothing. You can't get blood from a stone, so you're left holding the bag. Your health insurance might cover some medical costs, but what about the huge deductible? What about the months of physical therapy? What about the wages you lose because you can't work? This is where uninsured motorist coverage becomes your financial superhero. It steps in and acts like the insurance the other guy should have had. It pays for your medical bills, your lost wages, and even your pain and suffering, up to the limits you select. Underinsured motorist coverage does the same thing if the at-fault driver has insurance, but just not enough to cover your damages. Shockingly, in some states, as many as 1 in 5 drivers on the road are uninsured. You are sharing the road every single day with people who have zero ability to pay for the damage they might cause you. Opting out of this coverage to save a few dollars is one of the biggest gambles a person can take. It's like playing Russian roulette with your financial future every time you get behind the wheel. Always carry uninsured and underinsured motorist coverage, and get limits that are at least as high as your own liability limits. You are, in effect, buying insurance to protect yourself from the irresponsibility of others. Finally, let's quickly touch on 2 coverages that deal with immediate medical needs: medical payments, or MedPay, and personal injury protection, or PIP. These are designed to pay for medical expenses for you and your passengers right away, regardless of who was at fault in an accident. It avoids the delay of waiting for insurance companies to fight it out. MedPay is usually a smaller amount, like $5,000 or $10,000, meant to cover immediate things like an ambulance, ER visit, or health insurance deductibles. PIP, which is required in no-fault states, is more comprehensive. It not only covers medical bills, but can also cover a portion of your lost wages and other rehabilitation services. If it's available or required in your state, it's an essential layer of protection for the people inside your car. So there you have it. Liability for them, collision and comprehensive for your car, an uninsured motorist and MedPay for you. These are the core building blocks. Understanding them isn't just about being a smarter consumer. It's about building a financial fortress around your family and your future. But these are just the standard parts. This is the basic model. Where Farmers tries to set itself apart is in the options and special packages you can add on. Things like accident forgiveness, new car replacement, and custom equipment coverage. Are these valuable add-ons that are worth the money? Or are they just expensive gimmicks? We're going to dissect the most popular Farmers endorsements to see which ones actually provide real-world value, and which ones you can probably skip. Let's start with one of the most tempting options: accident forgiveness. The promise is simple and powerful. You've been a loyal, safe driver for years, paying your premiums on time, never causing a fuss. Then one day, a moment of distraction, a slick patch of road, and bam, your first at-fault accident. Normally, this is where your rates would skyrocket. But with accident forgiveness, Farmers essentially says, hey, it happens. We'll give you a mulligan. This one's on us. Your rate won't increase because of that one specific accident. So, is it a gimmick? Not entirely, but you need to read the fine print. Typically, you have to earn it. Farmers usually requires you to be accident-free with them for a specific number of years before this benefit kicks in. It's a loyalty reward. The real question is, are you paying extra for it? Sometimes it's baked into a premium package. Other times it's a specific add-on. Here's the calculation you need to do. How much extra are you paying per year for this protection versus the potential rate hike from a single accident? A typical at-fault accident can raise your rates by 30 to 50% for 3 to 5 years. That could be thousands of dollars. If the cost of accident forgiveness is just a few extra bucks a month, it's an incredibly smart bet, especially if you have a young or inexperienced driver on your policy. For a single veteran driver with a 30-year clean record, the odds are more in your favor, and you might decide to self-insure against that risk by saving the money instead. Our verdict: it's high value for families and anyone who wants ultimate peace of mind, but a potential skip for seasoned solo drivers. Next up, let's talk about that new car smell. You just bought a brand new vehicle. You signed the papers, drove it off the lot, and it's perfect. 2 weeks later, you're T-boned at an intersection, and the car is declared a total loss. Now, standard collision coverage will pay you the actual cash value of the car. The problem? The second you drove it off the lot, it depreciated by thousands of dollars. The actual cash value is now significantly less than what you paid for it, and almost certainly less than what you still owe on your loan. This is what we call being upside down, and it's a financial nightmare. You're left with no car, and a massive loan payment for a vehicle that doesn't even exist anymore. This is where new car replacement coverage becomes a hero. If your new car is totaled within the first 2 years and under 24,000 miles, Farmers won't just give you the depreciated value. They will pay to replace it with a brand new car of the same make and model. No haggling over depreciation, no getting stuck with a huge loan. They make you whole again. This isn't for everyone. If you're buying a 5-year-old used car, this coverage isn't even an option. But if you are buying or leasing a brand new vehicle, this endorsement is, in my opinion, non-negotiable. It transforms a potentially catastrophic financial event into a manageable inconvenience. The extra cost is minimal compared to the thousands of dollars in depreciation it protects you from. It's a must-have for any new car owner. Okay, what about when the accident isn't a total loss, but your car is stuck in the body shop for 2 weeks? This is where loss of use, or rental reimbursement, comes in. It seems straightforward. Your car is being repaired after a covered claim, and Farmers pays for your rental car. But the devil is in the details. This coverage isn't a blank check. It has a per-day limit and a total claim limit. For example, a basic plan might cover $30 a day, up to a maximum of $900. In today's market, finding a rental car for just $30 a day is nearly impossible, especially if you need an SUV for your family. You'll quickly find yourself paying out of pocket. And what if the repairs take longer than expected because of a parts delay? Once you hit that $900 cap, you're on your own. So the question isn't just if you should get this coverage, but how much you should get. Farmers offers different tiers. You need to be realistic about your life. Are you a one-car family living in a suburb with no public transportation? If so, being without a vehicle isn't an option. you should opt for the highest tier of rental coverage, maybe the one that offers $50 or $60 a day. The price difference per month is often less than a cup of coffee, but the difference in a real-world claim scenario is massive. On the flip side, if you work from home, have a spouse with another car, or live in a city with great public transit, you could probably get by with the basic level or even skip it altogether to save money. This endorsement is all about matching the coverage level to your daily reality. Now let's tackle a modern problem: ride-sharing. You decide to drive for Uber or Lyft to make some extra cash on the weekends. You turn on the app, and you're waiting for a ride request. During this time, you are in a massive insurance gray area. Your personal auto policy almost certainly has an exclusion for any commercial activity, meaning if you get in an accident right now, they won't cover you. The rideshare company's insurance hasn't fully kicked in yet either. Their robust coverage only applies once you've accepted a ride and are on your way to the passenger. So what happens if you get in a wreck during that waiting period? You're financially exposed in a huge way. This is the gap that Farmer's rideshare endorsement is built to fill. For what is usually a surprisingly small additional premium, this add-on extends your personal policy's coverages through that entire gray area. It ensures that from the moment you turn the app on to the moment you turn it off, you are fully protected. Let me be crystal clear. If you drive for any rideshare or even a food delivery service like DoorDash or Instacart, this is not an optional nice-to-have. It is an absolute necessity. Driving without it is a gamble you cannot afford to lose. The cost of a single accident in that coverage gap could lead to financial ruin. This is one of the most valuable and crucial endorsements available in the 21st century. Finally, let's talk about personalization. What if your car isn't just a stock vehicle? You've spent your hard-earned money on upgrades. A new set of custom wheels and tires, a high-end stereo system with a subwoofer in the trunk, a custom paint job or vinyl wrap. These things can easily add up to $5,000, $10,000, even $15,000. If your car is stolen or totaled, your standard comprehensive or collision coverage will not pay for these custom parts. They pay to replace a stock vehicle with stock parts. All that money you invested, it's gone. That's why Farmers offers customized equipment coverage. This endorsement specifically covers the value of your aftermarket additions. You're essentially buying a separate little policy for your upgrades. You'll need to keep receipts and photos to prove the value of the equipment, but if something happens, you'll get the money to actually rebuild your car the way you had it. Is this a gimmick? Absolutely not. It's the only way to protect your investment. If your car is completely stock from the hubcaps to the stereo, then you can obviously skip this. But if you've put even $1,000 into making your car your own, you need to call your agent and add this coverage. It ensures that you're not just insuring a car, you're insuring your car. So as you can see, these endorsements aren't just a random list of upsells. They are specific tools designed to patch the holes that exist in a standard one-size-fits-all policy. The key is to honestly assess your own life, your vehicle, and your risks to determine which tools you actually need in your toolbox. Now that we understand how to add these crucial layers of protection, which can increase your premium, it's time to flip the script. How do we get all this coverage without breaking the bank? The answer lies in a world of discounts that most people don't even know exist. We're going to uncover every single discount Farmers offers, from the obvious to the obscure, to show you how to strategically slash your bill and get the best possible protection for the lowest possible price. So let's start with the discounts that are all about you, the driver. These are the ones based on your age, your habits, and your history. Think of this as your personal savings profile. First up, the classic good student discount. If you or a young driver on your policy is in high school or college, this is a non-negotiable. Farmers, like most insurers, recognizes a strong correlation between responsibility in the classroom and responsibility behind the wheel. If a student can maintain a B average or better, make the honor roll, or rank in the top 20% of their class, Farmers will reward that diligence with a significant price cut. This isn't just a pat on the back for good grades. It's cold, hard cash back in your pocket. It's a powerful incentive for your student driver to hit the books, and it can often offset a huge chunk of that infamous young driver premium increase. But what about the student who goes away to college and leaves their car at home? This is where a lesser-known gem comes in: the distant student discount. If the school is more than 100 miles from home and the student doesn't take the car with them, you can get a serious discount. The logic is simple. The car isn't being driven daily by an inexperienced driver in a new, unfamiliar city. It's sitting safely in your garage most of the year. It's a huge win for parents of college kids, and it's one that many people forget to ask for when their child heads off to campus. Now let's talk about the big one for experienced drivers. The Safe Driver Discount, which farmers often calls their accident-free discount. This is your reward for keeping a clean record. If you've gone a certain number of years, typically 3 to 5, without any at-fault accidents or major traffic violations, you qualify. This discount is tiered, meaning the longer you maintain that clean record, the bigger the savings become. It's farmers' way of saying, "Thank you for not costing us money." It's a direct reflection of your risk profile. The less risky you are, the less you pay. It's that simple. Want to be even more proactive? Farmers offers a discount for completing an approved defensive driving course. This is particularly valuable for two groups: younger drivers looking to prove their commitment to safety, and older, mature drivers who can take a specific course to refresh their skills. You invest a few hours of your time in a small course fee, and in return you get a recurring discount on your premium for the next few years. In most cases, the discount pays for the course many times over. It's an investment in your safety that pays a real financial dividend. Speaking of mature drivers, there's also a senior driver or mature driver discount. Once you reach a certain age, typically around 55 or 60, and maintain a good driving record, farmers acknowledges your years of experience on the road. This isn't about age alone. It's about the proven track record that often comes with it. Combining this with the defensive driving course discount can create a powerful 1-2 punch of savings for senior drivers. And for certain professions, Farmers offers an affinity discount. If you're a doctor, nurse, firefighter, police officer, teacher, or scientist, among other professions, you may be eligible for a discount. The idea is that individuals in these fields are often seen as more responsible and less likely to take unnecessary risks. It's a professional courtesy that translates directly into lower insurance rates. Okay, that covers you. But what about your car? The second major category of discounts is all about the vehicle itself. What you drive is just as important as how you drive. Let's start with the new car discount. If your car is a recent model year, usually within the last 3 years, you'll likely get a discount. Why? Because newer cars are packed with advanced safety features, they're more reliable, and their performance in crash tests is generally superior to older models. They're simply safer, which means less risk for the insurance company. This leads directly to the next set of discounts, those for specific safety and anti-theft features. This is where you can really start to stack the savings. Does your car have factory-installed anti-lock brakes? That's a discount. Does it have automatic daytime running lights? That's a discount. Passive restraint systems like automatic seat belts or airbags? You guessed it, another discount. And it gets even better with modern technology. Advanced safety features like blind spot monitoring, lane departure warnings, and especially automatic emergency braking can all lead to even more savings. And don't forget about security. If your car has a passive anti-theft system, like an engine immobilizer that prevents the car from being hot-wired, that's a discount. If it has an active system like LoJack or OnStar that can help recover the vehicle if it's stolen, that's an even bigger discount. The harder your car is to steal, the less likely farmers will have to pay out a total loss claim. They pass that reduced risk back to you in the form of a lower premium. Finally, in the vehicle category is the alternative fuel discount. If you drive a hybrid or an electric vehicle, Farmers offers a discount to reward your eco-friendly choice. It's a small thank you for reducing your carbon footprint that also happens to reduce your monthly bill. So we've covered you, the driver, and we've covered your car. Now for the third and arguably most powerful category, discounts related to your policy itself. This is where strategy comes into play. The undisputed champion of all insurance discounts is the multi-policy discount, also known as bundling. This is the absolute cornerstone of saving money with a carrier like Farmers. If you have your auto insurance with them, and you also get your homeowners, renters, or life insurance through them, they will give you a massive discount on all of your policies. We're not talking about a few percentage points here. This can often be a 15 to 20% reduction, or even more across the board. From the insurer's perspective, it's a loyalty reward. You're a more valuable, stickier customer, and they're willing to cut their margins to keep all of your business. For you, it's a no-brainer. It simplifies your life by having one point of contact for your insurance needs, and it saves you a substantial amount of money. Right alongside bundling is the multi-car discount. If you insure more than one vehicle with Farmers, you'll get a discount on each car. The logic is similar to bundling. More business for them means more savings for you. For the typical American family with 2 or more cars, This is an automatic and significant source of savings. Next are the simple logistical discounts that many people overlook. The pay-in-full discount is a perfect example. If you can afford to pay your entire 6-month or annual premium at once instead of in monthly installments, Farmers will give you a discount. This saves them administrative costs and eliminates the risk of missed payments, and they pass that savings on to you. Similarly, there's the electronic funds transfer or EFT discount. If you set up automatic payments to be withdrawn from your checking account or credit card each month, you get a small discount. Again, it guarantees on-time payments for them and offers you a set-it-and-forget-it convenience that also saves you money. Paired with that is the paperless discount. Agree to receive your bills and policy documents online instead of through the mail, and they'll knock a little more off your bill. It saves them printing and postage costs, and it's better for the environment. These are small, easy wins that add up. Finally, there's the loyalty factor itself. While not always advertised as a formal discount, customers who have been with Farmers for many years often see preferential rates. Your long-term history of on-time payments and a clean record makes you an ideal customer, and that is often reflected in your renewal pricing. So let's recap the strategy. You start with your driver profile, good student, safe driver. You add on your vehicle's features, new car, safety tech, anti-theft. Then you cap it all off with the policy-level power-ups, bundling your home and auto, ensuring multiple cars, going paperless, and paying automatically. Each one is a layer of savings. When you stack them all together, you can fundamentally transform your insurance bill from a major expense into a manageable one. But here's the thing. All of these discounts we've just discussed are based on history, on static information, your grades from last semester, your driving record from the last 3 years, the features your car was built with. What if there was a way to get a discount based on your driving habits right now, in real time? A discount that you have direct control over, that you could increase every single day just by being a good driver? Well, there is. It's called telematics, and Farmers' program for it is named Signal. It's an app that monitors your driving, and it has the potential to unlock the single biggest, most dynamic discount they offer. But it also comes with its own set of rules, its own risks, and its own rewards. It's a game changer, but you have to know how to play the game. And that is exactly what we are going to break down next. So let's pull back the curtain on the Farmers Signal program. Think of it less as a simple discount and more as a digital co-pilot sitting in your passenger seat. It has a clipboard, it's taking notes, and it's judging your every move. But instead of a person, it's an app on your phone, and that judgment translates directly into dollars and cents on your insurance bill. At its core, Signal is what the industry calls a telematics program. That's just a fancy word for technology that tracks your driving habits. It's like a Fitbit for your car. A Fitbit tracks your steps, your heart rate, and your sleep to give you a score on your physical health. Signal tracks your braking, your acceleration, your speed, and your phone usage to give you a score on your financial health, at least as far as your car insurance is concerned. The magic happens right inside your smartphone. The Signal app harnesses the powerful sensors already built into your device. It's not some separate clunky device you have to plug into your car's diagnostic port like the old days. This is all done through the supercomputer you carry in your pocket. It primarily uses 3 key sensors: the GPS, the accelerometer, and the gyroscope. The GPS, as you know, tracks your location and, more importantly, your speed. It knows how fast you're going and compares that to the posted speed limit for the road you're on. The accelerometer is the sensor that knows when your phone is moving and how quickly its speed is changing. This is the tattletale for harsh braking and aggressive acceleration. It feels that lurch when you slam on the brakes or a G-force push when you floor it from a stoplight. And the gyroscope? That measures orientation and rotation. It helps the app understand if you're taking corners too sharply or making erratic swerving motions. When you put all this data together, Signal is building a detailed second-by-second profile of you as a driver. It then boils all that information down into a driving score, typically out of 100. A higher score means you're a safer driver in their eyes, and a safer driver gets a bigger discount. A lower score, well, that's where the risk comes in. But to really understand how to win this game, you need to know the rules. You need to know exactly what that digital co-pilot is looking for. There are 5 core behaviors that make up the vast majority of your score. Think of them as the 5 commandments of Signal. First, and arguably the most important, is braking. The app is hypersensitive to what it calls a harsh braking event. Imagine you're driving down the street, perfectly calm, and the car in front of you suddenly stops. You hit the brakes a little harder than usual to avoid a collision. You did the right thing, you avoided an accident. But the app doesn't see the context. It doesn't see the other car. It only feels the sudden, sharp deceleration through your phone's accelerometer. It flags that as a harsh brake, a sign of following too closely or not paying attention. A single harsh brake won't tank your score, but a pattern of them will absolutely destroy it. The key to mastering this is to drive defensively, leave plenty of room between you and the car ahead, and anticipate stops. Coast to red lights, don't race to them. The second commandment is the flip side of the first. Excessive acceleration. That feeling of rocketing away from a green light might be fun, but to the Signal app it's a massive red flag. It's a sign of aggressive, impatient, and statistically riskier driving. Just like with braking, the accelerometer detects that rapid change in speed and dings your score. Smooth, gradual acceleration is the name of the game. Think of an imaginary very full cup of coffee sitting on your dashboard. Your goal is to drive in a way that doesn't spill a single drop. That's the kind of smoothness Signal rewards. The third commandment is speeding. This one seems obvious, but there's a nuance to it. The app isn't just looking for you going 90 in a 65. It's constantly comparing your phone's GPS reported speed to its database of posted speed limits for that specific stretch of road. Going even 5 to 10 miles over the limit, especially consistently, will steadily chip away at your score. The app values a driver who respects the speed limit, not just to avoid tickets, but because it's a fundamental indicator of responsible behavior behind the wheel. It's not about one single trip. It's about the percentage of time you spend over the limit across all your driving. Now, the fourth commandment is the one that trips up a lot of people: distracted driving. This is the big one. Farmers is incredibly focused on this, and the Signal app is its primary weapon. How does it know you're using your phone? It's not listening to your calls or reading your texts. Let's be clear about that. But it is using your phone's internal sensors to detect handling. It knows when you pick the phone up. It can detect the motion of tapping and swiping on the screen. It knows if the phone is handheld versus sitting stationary in a cradle or a cup holder. Any active phone use, calling without a hands-free device, texting, scrolling through social media while the car is in motion, is a major penalty. It's one of the fastest ways to plummet your score. To the app, a moving car and a handheld, active phone is the ultimate combination of risk. If you want a high score, your phone needs to be mounted or put away, and you need to use hands-free technology like Bluetooth for any calls. Finally, the fifth commandment is a bit more subtle. It's about when and where you drive. The app takes into account the time of day. Driving late at night, say between midnight and 4 a.m., is statistically riskier. There are more tired or impaired drivers on the road, and visibility is lower. Even if you drive like a perfect saint during these hours, the app may still view the trip as inherently riskier, and it can slightly suppress your score. It's not a huge factor, but it's there. Similarly, the routes you take can matter, though this is a less direct factor. The focus is primarily on your actions, not the environment. So the app takes these 5 pillars: braking, acceleration, speed, phone use, and time of day, and feeds them into an algorithm. Every trip you take generates a score. Your overall Signal score is a rolling average of your recent trips. This is important. It means one bad day, one trip with a harsh brake and a bit of speeding, won't permanently ruin your discount. You can recover, but it also means you have to be consistently good. When you first sign up for Signal, Farmers gives you an initial, small discount just for participating. Think of it as a thank you for enrolling. But the real money, the big discount of up to 30%, is what you earn over time. After a probationary period, usually around 90 days, the app has collected enough data to establish your baseline driving score. That score is then used to calculate your personalized discount, which gets applied at your next renewal. The higher the score, the more you save. But here is the critical part, the risk we talked about. This is not a no-lose proposition. While a great score can lead to significant savings, a poor score can actually lead to a surcharge in most states. That's right. If the app flags you as a consistently risky driver, someone who is always braking hard, speeding, and using their phone, Farmers can actually raise your rates at renewal. They are making a bet on you. The data you provide is proof of whether that bet was a good one. They are rewarding good behavior, but they are also penalizing what their data shows to be bad behavior. This transforms the program from a simple discount into a high-stakes performance review of your driving, with your insurance premium as the ultimate prize or penalty. We've now cracked open the black box. We've seen the gears and levers that determine your score. You know the 5 commandments you're being judged against. But knowing the rules of the game is one thing. Knowing whether you should even play the game is another entirely. Is the potential reward worth the risk of being constantly monitored? Who is the ideal candidate for a program like this, the driver almost guaranteed to save a fortune? And more importantly, who is the type of driver who should run, not walk, away from the Signal app because for them it's a one-way ticket to higher premiums? That is the crucial strategic decision we need to break down. Let's frame this decision not as a simple choice, but as a bet. When you download the Signal app, you are betting against farmers. You're betting that your real-world driving habits are so much better than the average driver they've based your initial premium on, that they will be forced to give you your money back. Farmers, on the other hand, is betting that once they have a microscope on your every move, they'll find flaws that either justify your current rate, or, in a nightmare scenario, give them a reason to raise it at your next renewal. So, who wins this bet? Let's start with the person who should be sprinting to the App Store. The ideal Signal user is what the insurance industry dreams about. Let's call her predictable Penny. Penny has a 9-to-5 desk job. She drives a 10-mile commute on the same suburban roads every single day. She leaves at 8 a.m. and comes home at 5:30 p.m. on the dot. She doesn't speed because she's not in a hurry. She rarely brakes hard because she leaves plenty of following distance and the traffic flows smoothly. Her phone is in her purse on silent for the entire trip. She doesn't drive late at night because she's in bed by 10 p.m. On weekends, her driving is limited to the grocery store and maybe a trip to the park. To the Signal algorithm, Penny is a saint. Her focused driving score is a perfect 100 because the phone never moves. Her braking is smooth and gentle. She never exceeds the speed limit. Her driving hours are the safest possible. Her mileage is low and consistent. Penny is going to get the maximum discount, potentially up to 30%. For her, Signal is a no-brainer. It's free money for a driving style she already has. If you are Penny, if your driving life is incredibly routine, low risk, and you have the discipline of a monk when it comes to your phone, then you should absolutely use Signal. You are leaving money on the table if you don't. Now, let's talk about the person who should treat this app like it's radioactive. And here's the scary part. This person might actually consider themselves a good driver. Let's call him realistic Ryan. Ryan is a bartender. His shift ends at 1 a.m. He's a good driver, he's never had an accident, but his life just doesn't fit the algorithm's perfect box. He drives home at 1:30 in the morning. Strike one. That's the highest risk time period according to the data, so he gets penalized, even if the roads are completely empty. He lives in a city, so his commute involves a lot of stop-and-go traffic. He has to brake firmly, maybe even hard sometimes, when someone inevitably cuts him off. Strike two. The app doesn't know someone cut him off. It just registers hard braking event. Ryan also uses his phone for GPS. He has it on a dashboard mount, and he's using it hands-free, which is perfectly legal and safe. But the app's accelerometer can sometimes interpret the motion of him tapping a new address in at a red light, or even just the road vibrations as phone handling. Strike three. He's now being flagged for distracted driving, even though his eyes were on the road. And finally, on his way to work, there's a stretch of road where the speed limit drops from 45 to 30, and like most people, he sometimes coasts through that transition, briefly going 35 in a 30 zone. He's not recklessly speeding, but the app is binary. It's not about intent, it's about data. Strike four. Ryan, who has a perfect driving record, will get a terrible Signal score. The app will paint him as a distracted, aggressive late-night speeder. At his next renewal, he's not getting a discount. He's getting a rate hike. And farmers will have a detailed data log to justify exactly why. So if you are a shift worker, a city driver, someone who relies on your phone for navigation, or even just someone with a less than predictable schedule, you are gambling with your rates by using this app. You are handing the insurance company the very ammunition they could one day use against you. To truly understand this, you have to look at the 5 commandments of the Signal app, the metrics that determine your fate. First is focused driving. This is the big one. The app uses the phone's internal sensors, like the accelerometer and gyroscope, to detect if you're holding, tapping, or swiping your phone while the car is moving. This is their #1 predictor of accidents. The problem is, it's not perfect. A phone sliding around on the passenger seat, or a phone in a flimsy mount that vibrates a lot, can trigger false positives. The only way to be certain of a perfect score here is to have your phone completely untouched from the moment you start the car until you turn it off. Second is braking. The app flags any instance where you decelerate too quickly. It's measured in miles per hour per second. While this is meant to catch tailgating and aggressive driving, it disproportionately punishes drivers in dense urban environments. One yellow light you weren't expecting, one pedestrian stepping into a crosswalk, one car pulling out in front of you. These are not necessarily signs of a bad driver. They are signs of a complex driving environment. But the app doesn't see context. It just sees a data point. Hard brake. Third is speeding. This one seems simple, but the devil is in the details. The app compares your GPS speed to a database of posted speed limits for the road you're on. This database isn't always perfect. It might not be updated for recent changes in speed limits. More importantly, it's incredibly strict. There's no flow of traffic defense. If everyone is going 70 in a 65 and you are too, you are speeding. If you consistently drift 5 miles per hour over the limit, those small infractions add up and will tank your score. Fourth is time of day. This is the one you have the least control over. The app heavily penalizes driving during the highest risk hours, typically defined as between 11 p.m. and 4 a.m. This is based on decades of actuarial data that shows fatal accidents, especially those involving drunk driving, are most common during these hours. It doesn't matter if you are stone-cold sober driving home from your night shift at the hospital. The algorithm groups you in with the post-bar closing crowd, and your score suffers because of it. Finally, there's mileage. This is a double-edged sword. While the app tracks how many miles you drive, it's less about how much you drive and more about a baseline. Low mileage is good, but it's not a golden ticket. You can drive very few miles, but if you do it late at night while handling your phone, you'll still get a bad score. Conversely, even with a perfect score in all other categories, a high-mileage driver will find their potential discount is capped. The app is really designed to reward the low-mileage, safe-as-houses driver, not the responsible road warrior who drives 30,000 miles a year for work. So the strategic decision is this: you have to be brutally honest with yourself. Don't think about the driver you want to be. Think about the driver you are day in and day out. Look at those 5 metrics. Are you predictable Penny or realistic Ryan? Because once you enroll, the clock is ticking. The app has an initial learning period of a few weeks where it establishes your baseline score. Your performance during this period is absolutely critical. A few bad trips at the beginning can put you in a hole that's very difficult to dig out of. You are essentially on trial, and every single trip is evidence. The question then becomes, is the potential discount worth the constant pressure of being monitored? Is it worth changing your natural driving habits to game the system? For some, the answer is a resounding yes. For others, the mental burden and the risk of a rate increase far outweigh the potential reward. This focus on risk, data, and the financial bottom line is at the heart of how any insurance company operates. It's not just about discounts. It's about what happens when things go wrong. And this is where we need to shift our focus. Because getting a discount is great, but the real moment of truth with any insurance company, including Farmers, isn't when you're paying your bill. It's when you're standing on the side of the road, looking at a crumpled bumper, and you have to make that dreaded phone call. What does the Farmers claims process actually look like? Forget the commercials with the friendly, reassuring agents. What are the real steps, the hidden pitfalls, and the critical mistakes people make in the first 24 hours after an accident that can cost them thousands? That is the reality we need to dissect next. The screech of tires, the gut-wrenching crunch of metal. It's a sound that changes your entire day in a fraction of a second. In that moment, your brain is flooded with adrenaline. You're disoriented, maybe a little shaken up. And right there, in that state of shock, is where the first and often most expensive mistake is made. You get out of your car, see the other driver, and the first words out of your mouth are, "Oh my gosh, I'm so sorry." Stop. Right there. That simple, human, polite phrase can be interpreted as a legal admission of fault. It doesn't matter if you were just being courteous or expressing sympathy. In the world of insurance claims, those words can be weaponized against you. The claims process isn't a conversation between friends, it's a financial negotiation, and you just gave the other side a massive piece of leverage for free. The first rule in the 24-hour post-accident window is to control your language. Check if everyone is okay. Say, "Are you all right?" But never ever admit fault. Not to the other driver, not to their passengers, and not to the police officer who arrives on the scene. You can state the facts. "I was traveling straight in my lane. I was stopped at the red light." But let the evidence and the adjusters determine liability. Your job is to be a reporter, not a judge. Your second job, and this begins the second you're safely out of traffic, is to become a forensic investigator. Your smartphone is now the most important tool you own. Before you even think about exchanging a single piece of paper, You need to turn your phone into an unbreakable evidence locker. Start by taking more photos than you think you could possibly need. Don't just get a close-up of the dent. Get wide shots of the entire intersection or scene from every conceivable angle. Capture the road conditions, the weather, any traffic signs or signals, and any skid marks on the pavement. Then get photos of all vehicles involved from all four sides, even the undamaged parts. Most importantly, get a clear, readable photo of the other vehicle's license plate. This is non-negotiable. Now, you move to documentation. Don't just jot down a name and number. Take a picture of the other driver's license. Take a picture of their insurance card front and back. This is critical. People get nervous, they might write down the wrong policy number, or they might give you an expired card. A photograph is objective proof. Then, open your Notes app and get their phone number and email address. Ask for the name of their insurance company directly. Finally, and this is a step almost everyone forgets, take a picture of the other car's vehicle identification number, or VIN. It's usually visible on a small plate on the driver's side dashboard, right where it meets the windshield. This number is unique to that specific vehicle and prevents any future confusion or fraud about which car was actually involved. If there are witnesses, get their names and phone numbers immediately. Don't wait. A willing witness at the scene can become an unreachable ghost an hour later. With your evidence locker secured, the next question is, do you call the police? For anything more than a tiny parking lot tap, the answer is almost always yes. A police report is an independent, official record of the incident. It documents the parties involved, the conditions, and often includes a preliminary assessment of what happened. When you file a claim with Farmers, one of the first things they'll ask for is the police report number. Not having one can turn a straightforward claim into a he said, she said nightmare, where it's your word against the other drivers. Even if the police don't assign fault at the scene, the report itself is an invaluable piece of the puzzle. It establishes the time, date, location, and participants in a way that can't be disputed later. Now comes the moment of truth. The first call to Farmers. You have your evidence, you have the police report number. You dial the claims number. The person who answers will be polite, they will be empathetic, they will sound like they are 100% on your side. And now you need to understand their role. The claims adjuster, or the first notice of loss representative, has two primary objectives: to fulfill the company's contractual obligation to you, and to mitigate the company's financial exposure. These two goals are often in direct conflict. You will be asked to give a statement about what happened. This is almost always a recorded call. Do I have your permission to record this call for quality and accuracy? They'll ask. What you say on this recording is permanent. It becomes official testimony. This is not the time to ramble, to guess, or to editorialize. Stick to the facts you documented. I was traveling northbound on Main Street at approximately 30 miles per hour. The traffic light for my direction of travel was green. A blue sedan entered the intersection from a side street and impacted the passenger side of my vehicle. Be precise. Be calm. Do not say things like, he came out of nowhere, or, I guess I wasn't paying full attention. Those are speculative phrases that introduce doubt and can be used to assign partial fault to you, potentially reducing your payout. And if you are injured, even if you just feel a little sore, you must say so. The classic mistake is saying I'm fine because of the adrenaline. If you say you're fine on that recorded statement, and then wake up tomorrow with severe whiplash, you've created a major hurdle for your own injury claim. The correct phrase is, I'm not sure if I'm injured yet, I'll be seeking a medical evaluation. Once the initial report is made, the conversation will turn to repairs. The Farmers adjuster will likely say, we have a network of excellent, pre-approved repair shops in your area. We can recommend our Circle of Dependability shop. They guarantee the work for as long as you own the car. This sounds great. It's easy, it's convenient, and it's guaranteed. But you need to understand the dynamic at play. These preferred shops get a massive volume of business from insurance companies. Their primary client in many ways is not you, it's Farmers. This can sometimes create pressure to complete repairs as quickly and as cheaply as possible. This might mean using aftermarket or like-kind and quality parts instead of original equipment manufacturer, or OEM, parts from your car's maker. It might mean repairing a panel that a more independent shop would insist on replacing. You have the legal right, in most states, to have your car repaired at any shop of your choosing. The guarantee they offer is often just a marketing tool. Most reputable body shops already offer a lifetime warranty on their own work. Choosing your own trusted mechanic or a high-end certified collision center might mean a little more legwork for you. You'll have to get the estimate and submit it, but it ensures the person fixing your car is working for you, not for the insurance company. These decisions, what you say, what you photograph, who you call, and where you take your car, all happen within that first critical 24-hour period. Getting them right sets the stage for a smooth, fair claims process. Getting them wrong can mean delays, denials, and leaving thousands of dollars on the table. You've successfully navigated the immediate aftermath. You've filed the claim with precision. But the process is far from over. Now the negotiation begins. The adjuster gets the estimate from the body shop, they get the statement from the other driver, and they start making decisions. What happens when their valuation of your car comes in way lower than you expect? What is a diminished value claim? And how do you fight for it when your brand new car is now worth less, even after perfect repairs? And what's the real story behind the battle over those OEM parts? That's where the real fight for your money begins. Imagine this. You've just driven your brand new car off the lot. It has that new car smell, not a single scratch on it, and it represents years of your hard work. 2 weeks later, sitting at a red light, you get rear-ended. It's not your fault. The other driver's insurance, let's say it's Farmers, accepts full liability. They send you to a great body shop, the repairs are flawless, and the car looks exactly like it did before the accident. You breathe a sigh of relief. The system worked. A year later, you decide to trade it in for a newer model. You go to the dealership, confident in your car's value. The manager comes back with an offer that's $3,000 less than you expected. You ask why. He pulls up a vehicle history report. "See this," he says, pointing to the screen. "Structural damage reported. It's got an accident on its record. We just can't sell it for the same price as one that's never been hit." Welcome to the painful, often denied world of a diminished value claim. This is the hidden cost of an accident. Even with perfect, factory-quality repairs, your vehicle is now permanently branded. Its market value has diminished simply because it now has an accident history. Buyers, whether they're private parties or dealerships, will always pay less for a vehicle that's been in a wreck compared to an identical one that hasn't. That difference in value is your financial loss. And the person who caused that loss is the at-fault driver. Their insurance company, therefore, should be the one to compensate you for it. But here's the multi-billion-dollar secret. Insurance companies absolutely hate paying these claims. They will fight you on it, they will deny it exists, or they will use confusing formulas to offer you pennies on the dollar. Their primary argument is always the same. We repaired your vehicle to its pre-loss condition. But they are playing a word game. They restored its physical condition, but they did not, and cannot, restore its financial condition, because they can't erase the accident from the vehicle's history report. So how do you fight back? First, understand that the burden of proof is on you. You can't just tell the Farmers adjuster, "My car is worth less now, pay me." You have to prove it. This is not a battle you win with feelings. You win it with documentation. The single most powerful weapon in your arsenal is a professional, independent diminished value appraisal. This isn't your buddy who knows a lot about cars. This is a certified expert who will conduct a thorough analysis, compare your vehicle to others on the market, and produce a detailed report that calculates the exact amount of value your car has lost. This report becomes your demand. When you submit this to an adjuster, be prepared for pushback. They might try to dismiss your independent appraisal. They might even counter with their own ridiculously low calculation based on something called the 17C formula. This is a formula that came from a court case in Georgia, and insurers love it because it almost always spits out a tiny number. It starts with a 10% cap on the car's value, then applies a damage modifier and a mileage modifier, chipping away at the total until it's a fraction of what you actually lost. If an adjuster ever mentions the 17C formula, you know you're in a fight. Your response should be clear. That formula is not law in my state, it doesn't accurately reflect the market realities for my specific vehicle, and my professional appraisal is a more accurate measure of my true financial loss. You send your demand letter with the appraisal attached and you stand firm. Often the first offer is still a lowball. You negotiate. You remain polite but persistent. And if they refuse to budge, you mention the two words adjusters hate to hear: small claims. Forcing them to send a lawyer to court over a few $1,000s is often more expensive for them than just settling the claim with you. This entire battle over value is directly connected to the other big fight you might have, the battle over parts. When your car is being repaired, The insurance policy gives the company the right to use what are called like kind and quality parts, or LKQ. This is a nice sounding term for aftermarket or even salvaged parts from a junkyard. The reason is simple. They are significantly cheaper than original equipment manufacturer, or OEM parts, the ones made by your car's manufacturer, like Honda or Ford. Farmers, like nearly all major insurers, will push the body shop to use these aftermarket parts to save money. Their argument is that these parts are certified by third parties and are just as good as the original. But ask any high-end body shop technician, and they'll tell you a different story. Aftermarket parts can have issues with fit, finish, and material quality. A bumper might not line up perfectly, a fender might be made of a thinner gauge steel, or a headlight might not seal as well against moisture. More importantly, this affects your car's safety and value. Modern cars are complex systems. A bumper isn't just a piece of plastic. It's an integrated component designed to work with your car's crash sensors and airbag systems. Using an aftermarket part that wasn't designed by the original engineers could potentially compromise how those safety systems perform in a future accident. Does that sound just as good to you? So what can you do? First, check your policy right now. See if you have an OEM endorsement. This is an optional coverage you can add, often for a very small extra premium, that guarantees the use of OEM parts and repairs. If you have a newer car, this endorsement is one of the best investments you can make. If you don't have it, you can still fight. You, the vehicle owner, have the right to demand certain parts be used. You can argue that for safety components, things like sensors, suspension parts, or anything related to the airbag system, using non-OEM parts is an unacceptable risk. You can also get your body shop involved. A reputable shop wants to do the best possible repair, and they will often advocate on your behalf with the insurer to use the right parts for the job. And here's how it all ties back together. If the insurer forces the use of aftermarket parts against your wishes, it can actually strengthen your diminished value claim. Part of your diminished value appraiser's report can now include the fact that the car is no longer all original. It has been repaired with inferior non-factory components, making it even less desirable on the open market and increasing the amount of value it has lost. The fight for diminished value and the fight for OEM parts are two sides of the same coin. They are both about one thing: making you whole again. It's not just about making your car look the same as it did before the accident. It's about restoring its value and its integrity. The insurance company's goal is to close your claim for the lowest possible cost. Your goal is to recover what you are rightfully owed. Understanding the rules of this game is the first step to winning it. But what happens when you win too many times? Or what if you have a couple of claims, even if they weren't your fault? You might think that as long as you pay your premium, your insurance company will stand by you. But there's a secret scoring system, a hidden risk profile that every customer has. And if your score drops too low, you can find yourself getting a letter in the mail that changes everything. What are the secret triggers that can cause farmers to non-renew your policy, or even cancel it outright? And what can you do when you've suddenly been labeled too risky to insure? It's a scenario that plays out in mailboxes across the country. You open an official-looking envelope from farmers, expecting a bill or a marketing flyer, and instead your heart sinks. The words jump off the page: notice of non-renewal. It feels like a breakup you didn't see coming. You've paid your premiums on time. You haven't had a major accident. So why is farmers suddenly deciding you're not worth the risk? Let's pull back the curtain on the secret triggers that can get you dropped. First, we need to understand the two different ways an insurer can end your coverage: cancellation and non-renewal. Cancellation is the more severe of the two. It means they're cutting you off midterm. This is usually reserved for very specific, serious reasons legally allowed by your state. The big ones are failing to pay your premium, committing fraud or serious misrepresentation on your application, like lying about who drives the car or where it's garaged, or having your driver's license suspended or revoked. If you get a DUI, for example, Farmers isn't going to wait until your policy is up for renewal. They can, and likely will, cancel you as soon as they find out. Non-renewal is different. It's more common and, frankly, more mysterious. This is when Farmers decides that, at the end of your 6 or 12-month policy term, they simply don't want to offer you a new one. They've fulfilled their contract, and now they're declining to start a new one. The reasons here are much broader and are based on a complex calculation of risk that you've unknowingly become a part of. The most obvious trigger is your driving record. This isn't just about one speeding ticket. Insurers look for patterns. Multiple moving violations in a short period, say 3 years, sends up a massive red flag. It tells them you're not just having a bad day. You might have a habit of risky driving. A single major violation, like reckless driving or causing an at-fault accident with significant injuries, can be enough to get you non-renewed on its own. They see that one event and their algorithm screams, high potential for a catastrophic payout in the future. But here's where it gets tricky and where most people get blindsided: your claims history. You might think, I pay for insurance to use it when I need it. And you're right. But from the insurer's perspective, how and when you use it paints a picture of your future risk. Here's the secret. Insurance companies often fear frequency more than severity. Filing one large, legitimate claim after a major, unavoidable accident is one thing. But filing 3 or 4 small claims over a couple of years, that can be even worse in their eyes. Think about it from their perspective. A driver who files claims for every little fender bender, every cracked windshield, every minor scrape in a parking lot, signals 2 things. First, they might be more prone to incidents in general. Second, each claim, no matter how small, has administrative costs. It takes time, manpower, and money to process. A customer with high claims frequency becomes unprofitable, even if the individual payouts are small. This is why it's so critical to think twice before filing a claim that's only slightly more than your deductible. You might win the battle by getting a check for a few $100s, but you could lose the war by being labeled high frequency and getting non-renewed. And yes, this can include not-at-fault accidents. If you're constantly in situations where your car is getting damaged, even if it's not your fault, the algorithm might flag you as someone who is simply unlucky, or who parks in high-risk areas, or who is just around trouble. It's not fair, but it's how the risk is calculated. Now let's get into the reasons that have nothing to do with your driving or claims at all. This is the stuff that feels deeply personal and unfair. In many states, your credit-based insurance score can be a factor. If your credit score takes a significant dive, your insurance score likely will too. To an insurer, data suggests a correlation between lower credit scores and a higher likelihood of filing claims. So a major financial setback in your life could, bizarrely, lead to a non-renewal notice from your auto insurer. Another trigger is a change in your risk profile. Did you add a new driver to your policy? A teenager with a fresh license is one of the biggest red flags in the industry. The statistical risk of a 16-year-old driver is so high that it can fundamentally change the entire risk profile of your household, sometimes to a point where farmers' underwriting guidelines say, we no longer want this policy. The same goes for the vehicle itself. If you trade in your reliable sedan for a high-performance sports car or a massive, lifted truck that's statistically more likely to be in a severe accident, that can also trigger a non-renewal. But what about factors completely beyond your control? This is the most frustrating trigger of all. Farmers, like all insurers, constantly reevaluates the risk of entire geographic areas. Let's say you live in an area that has unfortunately seen a spike in auto theft, or severe weather events like hailstorms or flooding. Or maybe you live in a coastal state where the risk of hurricane damage is being repriced. Farmers might decide to reduce its concentration of risk in your entire zip code. They might non-renew a certain percentage of policies in your area, not because of anything you did, but simply because of where your car is parked at night. You become a casualty of a larger business strategy. So you've received the letter. What do? The first step is critical. Do not panic and do not let your coverage lapse. A lapse in insurance, even for a single day, is a catastrophic mistake. It makes you a much higher risk to every other insurer and will cause your rates to skyrocket when you do find new coverage. Your second step is to read the non-renewal letter carefully. By law, it must state the specific reason for the decision. If it's vague, your third step is to call your farmer's agent immediately. Be polite but firm. Ask for a complete explanation. Ask them to confirm the data they used. Is there a ticket on your record that was supposed to have been dismissed? Is there an accident listed that wasn't your fault, or that never even happened? You have the right to see your CLUE report. That's the Comprehensive Loss Underwriting Exchange Report, which is like a credit report for your insurance history. Review it for errors. If you find one, you can dispute it, and if you're successful, you can ask farmers to reconsider their decision. It's a long shot, but it's possible. If the information is correct and they won't reverse the decision, your fourth and most important step is to start shopping for new insurance immediately. Don't wait until the last week. Start the day you get the letter. Be prepared. You will have to disclose that you were non-renewed on your applications. Lying about it is misrepresentation and can get your new policy canceled. Yes, being non-renewed can make it harder and more expensive to get coverage. Some mainstream carriers might turn you down, but there are many other companies that specialize in insuring drivers with a few blemishes on their record. An independent insurance agent can be your best friend here, as they can shop your profile across dozens of carriers at once to find the best possible option. And if you're truly struggling to find any carrier who will take you, know that there is a safety net. Every state has an assigned risk pool, or a residual market. This is an insurer of last resort for drivers who are legally required to have insurance but can't obtain it in the voluntary market. The coverage is basic and the premiums are very high, but it will keep you legally on the road while you work on improving your record so you can return to the standard market in a few years. Ultimately, a non-renewal from Farmers isn't a judgment on your character. It's a cold, hard, data-driven business decision. It's a sign that, for whatever reason, their algorithm has decided the potential cost of insuring you outweighs the premium you pay. The best defense is a good offense. Drive safely, be thoughtful about filing small claims, maintain good credit, and understand that your relationship with your insurer is purely transactional. By understanding the rules of the game, the hidden triggers and the risk calculations happening behind the scenes, you move from being a passenger to being the driver. You can't control everything, but you can control your actions, your choices, and your preparedness. And in the world of insurance, that is the most powerful policy of all.